I don't mean to be an asshole, but if you cannot read financial statements, you should stick to passive investing. It takes about 100 hours to have bare minimum efficiency, and I'm going to cut that down to 20 hours in this video. PE ratios can be manipulated, especially if it's a growth company. Corporate accountants will take down goodwill in order to not pay taxes in that year. You're also not paying for a company's past profitability, you're paying for their future profitability. So here's how you look through the financial statements and see if a company is profitable, on the path to be profitable, and how much so. First, you want to go to the income statement and you want to look at gross margin. So you look at gross profit over revenue. That gives you an idea about unit economics. Then you want to go straight over to the statement of cash flows and you are looking for operating cash. This tells you, is the core business operating at a level that generates cash? How you're going to calculate free cash flow. You go to operating cash and then you subtract the CapEx. Now, CapEx is the investment in order to maintain the current business plus growth. For a growth company, you want to go to the previous year's CapEx. This is more accurate to what the business operating now is achieving, because if I'm investing $2 billion today, I just made $2 billion, but the $2 billion today is so I make $5 billion in the future, you understand how that's not indicative of how the business is doing right now, right? A quick rule of thumb is you can just go back to last year's CapEx, especially on a growth company, and then you can use that to figure out your true free cash flow. Now, again, we're buying future cash flows. You want to look forward and you want to see within 3 years, can I get to 10 times free cash flow? That's just a typical rule of thumb. In commodities, you probably want to be lower. At a 10% free cash flow yield, while the 10 years in the low fours, you're looking pretty. I'll just caution you by looking at PE statements. Specifically, Coherent's forward PE $6 EPS is like 32. That's not even talking about a squeeze in networking, which is almost guaranteed to come. Looking back, think about Amazon. Amazon famously did not make money forever. Why? Because they were pouring all of their cash back into CapEx so that they then could write off and amortize and depreciate in order to not pay taxes, to have more money to roll into the business. This is how growth companies, if they're good, operate. The majority of businesses and the businesses you want to own are trying to pay as little in taxes as possible, therefore making a higher PE. If a company is trying to maximize EPS in order to get investors, that's usually a value trap. Like, that is not the type of forward-looking company that you want to see. Those are executives that are misaligned towards long-term shareholders. I hope this helps. ChatGPT actually is your friend. Anything you don't understand about this video, go ask ChatGPT.